House prices in the UK, up, down, sideways or what? Well, I'd be a fool if I was going to try and predict where they're going to go in the next 6 weeks or even year or two. But let's look at some of the fundamentals of the market, different things which are having a particularly significant bearing on the real estate market for ordinary houses in the UK, and will do so for the next 5, 10 or 15 years. They're fairly obvious things, but it seems that people don't put them together. The first is, the UK is an island, it's small, it's densely populated, and that means we have no space, and people are very hyped up about any kind of new development. In turn, that means it's almost impossible to build new houses, as any developer knows, or to expand them or whatever. So you're lucky if you can get planning permission. If you're not, you just have to sit tight. But it means that there's a gap between what the market really wants, which is more housing, so that the prices come down. That's why housing prices are high, is because there's a shortage of property, and what we're going to get. So there's an absolute famine, shortage of housing, and that will continue. That's number one. Number two is that we have an absolute requirement for more housing for several reasons. Number one, we have an explosion of people living on their own. One, people are living longer. Two, their marriages and relationships break up more often. Three, they often take longer to settle down, and so on. Four, the number of people in a particular household is generally getting smaller. What's the next thing? Well, the next thing is immigration. The government has had two policies for immigration, one official, one unofficial. Official has been, we don't expect too many people from the new EU countries to come into the UK. Unofficially, we have no idea, and we're not counting, but it looks like at least 1 million new workers have come into the UK, registered or not, over the last 3 years alone. Maybe 200,000 have already gone home, but in the next 3 years another 1 million will come, and after another 3 years maybe another 1 million. So we are actually growing as a country. And what's more, these new entrants are younger people, they are fertile, and they're having babies. So they're growing new populations amongst themselves. So on the one hand, we have an absolute shortage of housing anyway. On the other hand, severe planning constraints and a lack of room. And then we have the social issues which cause the breakup of households. And then we have this influx of people. And then if that wasn't enough, there are other issues too. One of which is the collapse of confidence in pension funds and just about everything to do with fund management, which isn't surprising looking at the catastrophic performance of some of those funds over the last few years and changes in the tax regime associated with some of them. At the same time, the Chancellor of the Exchequer has seen it fit to continue to give people 100% tax relief on every pound of capital gain on property so long as they live in it. And what that means is that many people are buying houses that are more valuable than they actually need, larger than they actually need, in order to build up a pensions nest egg for the future. They will then change down, realise their asset and buy an annuity with it, or they might even use a reverse mortgage or some other kind of new financial tool to benefit from the equity which they've built up. But one way or another, these companies are taking advantage of the growth of equity and are encouraging people to borrow for their own properties more than they would normally. And because people have been fed up with pension funds, but also very much excited about property gains which have been created by all of these kinds of things we've already seen, then we've seen a further property gain in prices, because they've then decided not only to live in larger property than they need, but also to start buying property and renting it out. Now, it's true that they're going to see a 40% capital gains tax on that if they sell it quickly, but that reduces to only 25% if they keep the property for 10 years. And that's why the majority of buy-to-let landlords are actually in it for the long term. So when you combine all of these things together, the socio-demographic changes, the ageing population, the people coming in, the crowded islands, the lack of planning permission, the lack of new development potential, the collapse of confidence in pension funds, people over-investing in their own properties, and now the wave of buy-to-lets, well, you'd think that would be enough to sustain the housing market. And it's part of the reason why we're seeing house prices as they have been. And we may well see a wobble or two. When you see in some parts of London house prices increase by 20 or 25% per year, then you shouldn't be surprised if you get, for instance, a correction of 10 or 15% in a shorter time of 6 months. But always remember, All that means is you've just dropped back to where the prices were 6 to 8 months before, and it just means that house prices only increased by 10 or 12% in the year instead of 22 to 25%. So we need to take the long sweep of it. We need to be cautious before massively borrowing, say with 100% mortgages and things like that, unless you are certain you're going to be able to finance that property for a while, because as I say, you could have a short-term dip. But the fundamentals of the property market are very interesting. And there's something else too. When we bought our last house before this one, we bought it on a fixed mortgage at 11.5%, and we thought it was a bargain. And it was, because interest rates went up to 15.5% during the time that we owned that house. But the fact is that I was offered a mortgage on around 3.5 times my current earnings at that time, before any deductions, before tax or anything, 3.5 times my mortgage on 11.5%. But interest rates have been as low as 4.5% recently, and are still at the time of this video 6%. So what that means is, in theory, if you are going to apply a simple test of affordability, I ought to be able to finance a mortgage of up to 7 times my salary before the actual cost, the pain to me financially, becomes the same as it was when I bought that house on 3.5 times my earnings at 11.5% fix. But we're not seeing people borrowing 7 times salary because people aren't being lent 7 times salary. So that shows us that there is room for borrowing more in terms of affordability. And there's something else. You have to think what people spend their money on other than housing or health or education. 3 things which have actually gone up in price. Energy, you might say, that's gone up a lot, but has it? Oil prices in June 2007 were still cheaper in real terms by about $10 per barrel than they were at the peak of the 1970s crisis. That's a strange fact. So energy costs are actually cheaper than they have been historically, even though there's been a recent rise and people have felt the pain of it. What about other things? Well, the cost of a DVD or a video camera, the cost of mobile phones, all of these things are falling towards zero. The cost of washing machines or cars or ping pong tables or garden furniture, all falling towards zero. The cost of just about every physical commodity or manufactured thing that you could possibly want to buy has fallen. It's true, commodities like copper, steel have risen, the raw materials cost has risen, but the final manufactured cost has fallen in real terms, year on year, pretty much steadily, as a result of 2 things: globalization and the internet. Now, and of course related productivity increases that come from new technology and other things. Now, what it means is this: whereas someone on the equivalent in real terms of, let's say, $50,000 a year today would spend a certain amount on food and CDs or mobile phones or that sort of thing, if we look back 20 years, they would have spent a much higher amount on those same things. So while the cost of almost everything in their lives has fallen, it's given them spare spending capacity. Now, I said that they would be able to afford, in theory, a mortgage of up to 7 times salary probably, and still feel no more pain than they would have done maybe 20 years ago on a mortgage of 3.5 times salary, because the interest rates are lower. But now we factor in the possibility that they actually need much less remaining income to finance things like a loaf of bread or a pizza or a telephone call to another side of the world. So when you put those things in as well, it probably means that for many people, they could manage a mortgage of maybe 8 times, even maybe 8.5 times their salary, and it would still be less painful for them than it was for us on 3.5 times salary at 11.5% and sometimes peaking up as high as 15% land back in the 1970s or early 1980s. So now we begin to understand that the UK housing market is highly complex. There are many factors operating, but many of them are supporting house prices rather than bringing them down, which is why I think we will continue to see, on average, over the next 5 to 10 years, 15 years, that house prices stay higher than they have been historically. But we will see.